Crazy moments happening. Just gonna make sure everything is online. Oh, I made some tea. I want my tea. Okay, I'll get to the tea later. So, yeah, you can already tell looking by what I'm looking at. We're not at a pretty situation. Now, I've mentioned previous videos, this sort of bluish trended line I've drawn, um, or the pathway, comes from the COVID times. Let me kind of refresh on that angle. So, we had this sort of fluctuation here when COVID came out. The previous sort of pattern that happened here, the downtrend here. So this smaller downtrend here, and then this downtrend. These were insiders selling off, right? These were, I wouldn't say crazy, a lot of insiders, but a good amount of insiders. These were definitely just the majority. Hedge funds, politicians, who knows what. And then the retail selling off was down here. Now, that's a big retail response considering, right? Now, I've seen the same pattern happening here in a much more scaled up long-term fashion. And we still had that same retail insider sell-off. This was, I believe, Rosenberg selling off within this bracket of time here. But it wasn't, potentially, Rosenberg was one of the only ones that knew or was reported to sell out. But who knows how many others were selling off. Again, also we're looking at the SPY SPX index, secondary index. But if we even look at the SPX, we're still going to be looking at the same trend. What I had predicted was that we have some time to reach a $490 value. This would be a psychological breakdown. We already saw insiders selling off within this area. And insiders always have an idea of futuristic, especially politicians. They have an inside idea of the futuristic extent of the market. So we had a bit of a sell-off from insiders. Retail caught it. We went back up. It was a bit of a boost. The fuse kind of calmed down. We fell down. We went back up. This is where it surprised me. I would have assumed we would have brought ourselves back up, but news is unpredictable. The first red bar here that broke us completely out of our trend was the new virus type that came out in Africa. Since people are pretty much used to the virus, this type, that type, this type, that type, we look like we came back up. Like we kind of recovered a bit. However, not only a day later, Mr. Jerome Powell says, okay, let's revisit tapering. Let's redefine or clear up this transitory definition, which means the interest rates will eventually, within a couple of months, start increasing. That brought the whole market down completely. So, we've completely diverged from the pattern, which, it was supposed to be somewhat of a psychological drop up here. So we may be visiting a huge market correction. Now, this wasn't of the only type of data based on what I've analyzed. This is just the typical pattern of technicals. What I've found recently, if I remember where it was here. So the SPY, not the SPY, but it'll still matter. It's the end, Nasdaq, where you at? And that. The Nasdaq runs similar to the SPY. The Nasdaq has 3,300 companies. The SPY has 500 companies. However, we're going to see an eventual dismissal because as the Nasdaq has increased over time, this index down here, which is the MMTH, shows the percentage of companies above the 200 moving average. Remember, if you haven't seen the 200 moving average, the 200 moving average is a 200-day estimation of this line down here that's very smooth. In normal case scenarios, we see stocks reaching on a crash. It's kind of the last fail-safe location. And normally it should bounce off of that 200 MA. Now there's also smaller values, a 7 MA, a 25 MA. Those are very variable based on day trading, but the 200 MA is a solid indicator over a long period of time, the strength of a particular market. Now, we have diverged very far away from our 200 MA on the Nasdaq, let alone all the other indicators like SPY. But this interesting divergence, which can be seen in the fact that at this point we went up on the Nasdaq, but in the same point here we went down. This means as our overall market looks like it's healthy and increasing, the amount of companies that are stable above the 200 MA has decreased over time. Players, investors, people, companies, corporations, whoever are hedge funds specifically, are moving their diverse portfolio from all the companies that they wanted to go into, tech companies overflated, medical companies now with the variants, all these companies that they want to make money from, they're moving them down to a smaller few stable corporations. In a general sense, if you take a look at the heat map, which we'll take a look at actually, I can tell you that they're moving all their money to Apple, of all companies. Look at this heat map yesterday. It's red, it's blood all across the board. But Apple's chilling. Could tech be, or Apple specifically, be the new gold standard? I guess people believe this. So, as most of these corporations are losing momentum up, falling below that 200 moving average, as our percentages diverge from how many corporations are doing great above 200 versus falling below 200 in a bear market, our overall market still goes up. So a lot of money is concentrating itself into smaller and smaller sectors of the market. This is a hedge. When people start taking money out in the effect of a huge market crash, there will be a few companies that will hold value over time. Apple, Tesla potentially. They've actually had a good run as well. Microsoft, give or take. Yeah, Tesla's a little bit above green. Still green, amazingly. And Pfizer, since they exclaimed that they can help with the new variant. While Moderna is suffering because they were saying, oh, it's going to pose a problem. So either Pfizer is talking bullshit to keep their stock up and Moderna is telling the truth, or Moderna is the primitive of the two companies and Pfizer is apparently better. We don't know. We don't know until we figure out more time for this new variant. So Nasdaq somehow going up since February. Since February, Nasdaq going up. But since February, the distribution of successful charts in the market has decreased and less companies have been doing better or well, which is sketchy in the first case scenario. The SPY, again, giving off that sort of insider sell-off, the retail breath up and a very early stop or intervenience to what we should have went up further now is breaking down. We could have a side chop for a bit and we could go down, or we could just straight up go down. In fact, some of the possibilities here will look like this. So first and foremost, we effectively have a resistance point, a very, very strong resistance point. This is going to be a huge, huge attempt to get through. We had one denial, 2, 3, 4 denials. Now, if you don't break on the fourth try, you're gonna have a bad time. It just so happened that this new variant came after the fourth trial, bringing us down. We probably could have went up had not the variant appeared. Now from here, we have the typical possible option, straight down to a strong support like 400. We'll check and see what happens between the smaller supports here. We could even go all the way down, but case scenario, that's step one. We could have good news happen, and we could have a rebound, a possible retest. We're gonna try and find or see if we're gonna have a double top again. If we keep having these double tops, we're gonna have a bear market. So this is a potential one, the worst case scenario, if you will, straight down. The second case scenario, better but possibly low chance, is that we go up, or higher chance maybe, it will go up, drop down back into our potential pathway. And the third chance, possibly, is breaking through on the fifth try. Meeting that typical or the predictive form of the 4, and then continuing a drop from there. Why would I say that? Well, our market's already overinflated, 250% overinflated, from the words of Warren Buffett. There's no case scenario where we're gonna keep going up without a problem, especially considering we're now entering higher interest rates within the next year. December brings our debt ceiling decision for the great politicians that benefit themselves. We either pass it and then we go up, but with a lot of depth and a reduced, with greater depth, yes, but no reduced score. We deny the debt ceiling, which Republicans might highly do because they're tired of debt, which makes sense. We deny the debt ceiling, we get stuck, we fall down because the US credit rating will decrease. But if we increase the credit rating, we do have a look up. However, we still have this new variant, and we have tapering to an ending with interest rates being hiked. So there will be some pullback somewhere. Predictable? Potentially. But at the moment, I'm really looking at a possible yellow path. We might have a false break up, get a double top denial. We already kind of have a shoulder to shoulder. I think it was on the head and shoulder pattern on the NASDAQ. I am kind of sketched out from the SPY. I think the SPY is highly manipulated. And I'm looking at the weeks. So we do have a head and shoulder pattern happening on the NASDAQ. There's the head, shoulder 1, shoulder 2. This could be a definite prediction of the next steps when you have this left shoulder, top, right shoulder. Normally you're going straight down. So I believe the NASDAQ is a better indicator. I think it's less manipulated than the SPY because everyone talks about the SPY. The media, public media is all about the SPY. Market's doing great. The SPY is amazing, blah, blah, blah. But once in a while, they'll drop a line about NASDAQ. I think, honestly, NASDAQ has more companies involved, about 3,300. So it's harder to boast it. And considering that the NASDAQ is losing a majority of companies. Right now, only 39% of NASDAQ companies are above the 200 moving average and going down. The last time this happened was, let's do weekly again. If we'll take a look at some details here. This bottom part here is very important. This low value of about, call it 3%, the lowest that the percentages went down to, is a very good indicator of a reversal. But you notice that these happen at specific times. The 2020 COVID time reversal. The 2008 market crash of the housing market crash also had a reversal. If it went back further, you'd probably even notice that the 2000 internet bubble also reversed within that area. So it looks like we're at a downturn. The concentration of corporations above the 200 MA should reduce drastically, down to a couple of main companies, potentially top medical company Pfizer. Apple seems to be doing the gold standard process. When the market goes down, people go to Apple as a safe haven. Tesla seems to be also on the same case scenario. Obviously Microsoft, not so much. They're already down. But Apple, Pfizer seems to be strong, and Tesla seems to be steady as well. All the other ones are small caps. They're going to change green, red between different days. So my perspective is Apple is a safe haven, Tesla's a safe haven, Pfizer might be, but is very highly dependent on what's going on with the virus. And since we're kind of in a big question mark, we don't know yet how bad this new variant is. Some are saying it's nothing, it's super weak. Sure, it's more infectious, it infects more people easier, but the symptoms are super weak and they're not as bad as the previous ones. Cool. Others are saying, oh, it's bad and the vaccines won't protect you from it. There's just so much misunderstanding now with the newest viral strand. We don't know where Pfizer is going to go. So I wouldn't even recommend. I'm personally staying out of the medical sectors. I've lost a lot of money considering back in the beginning of the COVID days, I said, hey, I'm going to go in because the news told me to. And then I went down and I lost like a couple of thousand. I'm just not playing medical. Too intertwined with the public media, too intertwined with uncertainty. Apple's good. It has a strong running record. Tesla's amazing. I looked at some financials earlier. In fact, I was analyzing some of those financials. Tesla's absolutely ripping it, making so much profits, reducing its debts completely. And basically, you can see debt to assets, reducing debt over time, increasing assets and liabilities, or keeping liabilities low while increasing total assets. And going through all the financials on Tesla, they are basically set to moon. They have a split coming up, so a lot of people are excited about that split. They're going to buy in. It is $1,100 per Tesla stock, but to maintain a cash flow, definitely a worthwhile place. Apple, slow growth. I feel like they're probably running on a steam until they enter the EV, electric vehicle market. But they're stable. They're kind of not moving. They're good for maintaining your value, especially during this crash. So potentially, Apple's a good safe haven for a non-changing value. Tesla, I believe, is still unveiling billions of opportunities, from solar panels to batteries for the home. The media likes to say Tesla is just a car company, but they don't understand the software behind it. They don't understand the fact that they're going to make autonomous vehicles. They already have the systems for it. They're trying to tell you that Ford and Nissan and Honda are going to do it, and GM, they're all going to do this autonomous system. But Tesla's been doing it for the last 5 years, gathering data, perfecting their artificial intelligence unit for 5 years. GM and Ford are not going to do this until 2025, 2026. Even if Apple enters the market, they don't even have their own hardware. Tesla's hardware is completely manufactured by them. So even Apple is not going to be able to, because they get their hardware from China. Honestly, personally, Apple's a hype, it's a culture, it's a groupie indication of value, and people just kind of get stuck on the fact that, oh, Apple's a thing, but not really. So my case scenario, Apple's good, but I think futuristically it can get replaced. So market's red, shit's going down. I have taken half, 50% of my stocks, put them into crypto. Crypto's still on a running run. It's kind of basing, it's deciding what to do. Of all the cryptos, Ethereum is going to be the most stable, most unifying crypto of usage. Ethereum is doing much stronger than Bitcoin is. Look at this. There's Ethereum. There's your boy Bitcoin. Still low, 57, 58. It tried for a peak, got 68 way back. Not that way back, but 11th November. Broke down. But Ethereum on its actual format is based to be used in a specific way. So Ethereum is gonna grow just because of its usage, not because people are buying it. It's gonna have a natural growing factor to it. So Ethereum is the best place to be. Bitcoin also, not saying negative on it, Bitcoin's still a good place to be. But as far as percentage growth, Bitcoin can double, Ethereum can triple, quadruple, quintuple, up to 1,000%. Yeah, up to 1,000% as far as possibilities go, based on its usage. Those are my strategies. Right now, I'm 50-50 on the market. It could go down, it could go up. I've just done that, 50% in the stock market, 50% in crypto, and I'm just watching to see what the next market steps are. So that's it. Be ready for anything. We've got options here on where we're gonna go. And I'm watching every single day to see the possible directions from there.